News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, Garrett Ray, and Brice Payne, helping you retire the job and keep the paycheck. In the studio this morning, you've got Brice Payne and Garrett Ray. And this morning, we're talking about what retirees need to know about the big, beautiful bill and what's inside that bill that could impact you financially. Good morning, Brice. How you doing?
The BBB. Let's get into it. I'm doing good. Garrett, how are you?
Doing okay, sir.
Good.
Have
a good 4th of July week off there?
We did. Yeah, we did. We spent it up in the mountains of North Carolina, and so it was all good with the family.
Very good. Yeah. As you know, I went to Vegas and, of course, came back, as I seem to always do when I come back to Vegas, came back with a little bit of the COVID, but don't know why that happens. But
I wonder why.
But not too bad this time. But let's go ahead and do our Wealth Guardians salute there, Garrett. Take it away on that.
Yeah, we always want to recognize our men and women in uniform and our community first responders right up top, the first part of the segment of the show. What you guys do is often overlooked, and we know you work long and hard hours, and it is certainly hardest on those family members that at times you have to leave behind. We just want to thank you from the bottom of our hearts of everything that you guys do.
Absolutely, and I'll second that, and I know Doug will second that as well. So, of course, one other thing that we do here before we get into the meat of the show is we have that little segment that we call Better Get to Know Your Wealth Guardian's Advisor, where we ask ourselves a question and you ask yourself the same question as well, just so we have a little bit better chance of relating to you, not just being some voice on the radio out there. So, Garrett, here's my question to you and to everybody else out there. Garrett, what is your favorite TV show that is currently running?
Yeah, this answer might surprise some people, but it's really nothing. I don't use TV to watch shows per se. I'll watch news, I'll watch sporting events.
Oh, there you go. Okay, so sporting.
Sporting events.
Is your favorite show on?
And then I'll, me and my wife will do like Netflix, series and stuff like that, but not like an actual on cable TV. Watch the show is. Well, I don't really do that anymore.
Yeah.
So
I don't too much, with the exception of one show.
Okay.
Always Sunny in Philadelphia.
Okay, is that actually still running new episodes?
Season 17 right now.
All right, okay.
And I never fail to get a few good chuckles out of that every time that it's on. So we're in the 17th season. So but to be honest, it's about the only show, just in the same way that you said it. I don't know, hey, it's time for this or what. No,
it's
news or sports. That's about it for me as well.
Yeah.
All right, well, let's go ahead and get on topic here. A new tax bill has officially passed. You've probably heard it mentioned as the big, beautiful bill. And while most headlines are going to be focused on the politics, what we're going to focus on is what it means for your retirement. So the choices you make in the next year or two could actually have a significant impact on how much you keep, great, and how much you go to Uncle Sam, not so great. And let's tackle the first one here, Garrett, the marginal tax brackets. They have been extended.
Yeah, folks, if you came here for our political commentary, sorry, you're not going to get it. We're sticking straight to what it means for your retirement and the financials inside of the big, beautiful bill. But marginal tax brackets, they are extended. So the lower tax brackets that initially came to be started in 2017. This was a start from the original Trump administration. Mm-hmm. Those remain in place. They were carried over by the Biden administration. The verbiage will describe this as making brackets permanent, but if we know our politicians in D.C., permanent is not actually permanent, but that's what the current administration is putting out there.
So basically there was no change as far as the marginal tax brackets go. Well, somebody out there might be saying, well, Brice, Garrett, what are our marginal tax brackets right now? Well, I'm glad you asked. So let's go over this right now. Let's start off with a single person.
Okay.
After your standard deduction, whether that is $20,000 or $30,000 or whatever your standard deduction might be, that part you can look at as your tax-free income. There was 0% tax attached to whatever the standard deduction was. Then the next rate is going to be 10%. And that is for every dollar that goes up to $11,925. Again, this is if you're filing single.
Mm-hmm.
And then if you make $11,926, well, then that last dollar, the $1, is now going to be taxed at 12%.
Correct.
And so that range goes from $11,926 up to $48,475. That's taxed at 12%.
Yep.
And again, this is a tiered system. I know a lot of people understand that and they'll say, well, of course it is. But Garrett, you and I know that when we have these planning conversations with people who are coming to us, a lot of times they're not aware of what that means.
Yep.
What that means is, let's say that you did make $11,926 and you were in the 12% tax bracket.
Mm-hmm.
That does not mean that all of your income was taxed at 12%.
Correct.
All it means is that whatever amount was over $11,925 was taxed at 12%. That first $11,925 will always be taxed at the 10%.
Right.
So just because if you made $11,926, okay, technically you were in the 12% tax bracket, right?
Yeah.
That's not the important thing to remember. What was your effective tax rate?
Right.
Is the important thing to remember. And a lot of people don't realize that they are separate. So I just want to clarify that for everybody. Well, after the 12% tax bracket, it's 22%.
Okay.
And that's from $48,476 all the way up to $103,350. Then we get a small little bump to 24%.
Yep.
All right. So that goes from $103,351 up to $197,300. And then we got the 32% tax bracket. That goes from $197,301 to $250,525.
Yep.
And we got two more brackets to go. There's the 35%, and then there's the 37%. The 35% is $250,526, all the way up to $626,350. And then if you make more than that, that's all going to be taxed at 37%. So that was your single. Let's go over the same thing now with the married filing jointly.
Okay.
At the standard deduction, of course. Then the 10% bracket covers you from all the way up to the next $23,850.
Yep.
Then the 12% tax bracket takes you from that amount up to $96,950. And then the 22% tax, that's the biggest jump there, is between the 12 and the 22.
Yep.
So
the 10, yeah.
Yeah, so that's a 10% jump there. There is nothing even close to 10% after that.
Yep.
So you're in the 22% tax bracket. That goes all the way from $96,951 to $206,700. Then a little bit of a bump up to the 24% tax bracket. That's for everyone making up to $394,000, from $206,701 to $394,600. And then the 32%, from that number up to $501,050. And then the 35% is that number up to $751,600. And then the 37% is the $751,600 and up.
Yep.
So that is our marginal tax rates. That has not changed. It was scheduled to change. It was scheduled to go back down to the prior rates, but of course they passed this bill in time, so it is basically just staying. So that's your first one. If you're just tuning in, you're listening to the Wealth Guardian Show, and we are talking about the big, beautiful bill and what it means for your retirement plan. So that was the marginal tax brackets. Garrett, let's now go to the standard deduction made permanent. Tell us about this.
Yep. So standard deduction, this is when you're filing your taxes every year, whether you do it yourself or you've got a CPA doing it. The way that the Trump administration has essentially designed these tax brackets and the deductions, to be fair, is that really for the vast majority of tax filers, they're trying to steer you towards the standard deduction. And if you got a good CPA, depending on your circumstance, if you're not a small business owner or you're not a super high income earner, or you've got, 14 different investment properties, for most families, the standard deduction is probably your best bet.
Right.
You're no longer itemizing tax deductions like you may have, 5-10 years ago. So this standard deduction was made permanent. The higher standard deduction that would have also expired after this year was made permanent in the big, beautiful bill. The idea is it's going to continue more simplified tax filing processes for many Americans. That's the idea.
Right. Less itemization going on out there.
Yeah, and the I guess the general thrust of it was to try and simplify tax filing for Americans, because there is still quite a few people who do it by themselves, or they might use some sort of software to file their taxes for them, but they're still the ones doing all the computing. So that was the idea behind that standard deduction. So whether you're single and taking the standard deduction or you're married filing jointly taking the standard deduction, that's going to remain the same. That's not going to revert back to a more itemized structure.
Exactly. All right. Well, let me just mention it. Taxes, when we're financial planners, retirement financial specialists, part of the name of the game for us is having our client's portfolio allocated appropriately.
Mm-hmm.
The other half of the game is making sure that we keep as much money out of Uncle Sam's hands as we can by knowing how the game is played, knowing what the rules are. So it is not just about what do I put in my portfolio to get myself set up for the most growth potential. Doesn't do you any good to have a lot of growth if you're giving a lot of it away to Uncle Sam.
Sure.
So that's the second part of it. And if you think, hey, I might not be knowing all the tricks of the trade here where I can keep as much money out as possible out of Uncle Sam's hands, I need to talk to a retirement financial specialist. Well, then you're in luck. You're listening to one. So let me give you our phone number. It's 336-391-3409. That's 336-391-3409. We'd love to sit down with you if you're approaching retirement. You've got $400,000 or more set up for retirement, and you think, I've never had a financial planner, and maybe I do have one, but I'm not sure that he's doing everything for me. By all means, a financial planner is more than just an investment advisor. So again, 336-391-3409. We do not charge for our meetings. We'd love to sit down with you and see what services and expertise we might be able to offer to get you in the best place possible for your retirement. We do have to cut away for a break here, but Garrett, you know what time that means.
I'm sure you got a trivia question.
It's true. Don't say it like that. Come on, man. This is fun. All right, here's our trivia question.
All right.
On August 13th, 1997, that's 28 years ago,
Okay.
this cartoon made its debut on Comedy Central.
Mm-hmm.
Well, what is the show? All right. That is our trivia question. Stick around for the answer to that on the other side of this quick break. This is Brice Payne. With me is Garrett Ray, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM WTOB. Welcome back to the Wealth Guardian Show, where we help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Garrett Ray. In the second segment, we're going to continue our discussion around the big, beautiful bill and what that means to your retirement plans. Now, before we answer that trivia question we left Garrett and you hanging with, let me ask you this question. Are you planning to retire? Of course you are. Well, hopefully you are. Have you met with a retirement income certified professional who's also a fiduciary? If you have not, I'm officially inviting you right here, right now, to take us up on a complimentary review of your current retirement situation. As certified retirement planning specialists, we're going to put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security, tax efficiency, with the additional benefit of often reducing both the risk and fees of your current plan. So if you've put aside at least $400,000 and you want to take us up on this no cost, no obligation review, here's how you do that. You pick up the phone and you call us, 336-391-3409. Let me give that to you again, 336-391-3409. If you'd rather do it the internet way, our website is thewealthguardians.com. That's thewealthguardians.com to learn more about us and how we might be able to service you in your retirement situation. Let us show you in black and white how to retire the job and keep the paycheck. Okay, let's move on to that trivia question. Garrett, remind me, what year were you born?
1985.
All right, so on August 13th, 1997, that would have made you 12 years old.
12 years old.
28 years ago, this cartoon made its debut on Comedy Central. As easy as that. What is the show?
I've narrowed it down to two in my head.
Tell us what the two are, then tell us which one you're picking. I'm curious.
Okay, that's the two in my head are between South Park and Family Guy. I'm going to go South Park. Okay.
Actually, Family Guy was Fox.
That's actually what I was thinking about. I was like, I couldn't remember if it was on Comedy Central or not.
It was a Fox show.
Okay.
And
Yep.
yeah, so it's been running for 28 years. That's quite a long time. I think that is second only to The Simpsons.
The Simpsons,
as far
is
as
it?
cartoon goes. Have you been a fan of South Park?
Oh, yeah.
Yeah?
South Park, it's, that's kind of when I wasn't quite a teenager, but, you start becoming a teenager and that type of comedy is humorous. So
Just like the Always Sunny in Philadelphia, it's that same kind of humor. Do you happen to have a favorite episode? Mine is the Respect My Authority.
Oh yeah, well that's of course that's a good one.
One of the earlier ones.
Yeah, that's definitely a good one.
Yeah, they've gone really strange episodes in some of them, but yeah, that early one, Cartman with his Respect My Authority. Okay, let's keep going on this here. Now we got to only a couple of them on the first one. Let's go now to number 3, the major changes to the SALT cap. That's the state and local taxes cap. This is good news for us. I think just about everybody. I don't think for anybody this is bad news. So talk to us about this one, Garrett.
Yeah, so if you're out there wondering what the heck does SALT cap stand for, that is just an abbreviation for state and local taxes. And this is where Brice and I are going to throw the change up. So in the previous segment, if you were listening to the first segment of the show, we told you, hey, most people are going to be incentivized somewhat to take the standard deduction. Well, if you happen to be one of those individuals that does itemized deductions, this is good news for you. So you can now deduct significantly more state and local taxes on your federal return than you could under previous law. This is good news for people with high incomes, or perhaps you've got a large real estate portfolio, large real estate property tax bills.
Anybody who's itemizing.
Anybody who's itemizing at all. If you're in that bucket, you're going to have a lot more limits than you did previously, because previously you were limited to only $10,000 worth of itemized deductions for state and local taxes. So again, if you own properties in multiple different states, if that's something that looks like you, this certainly, the big beautiful bill at least opens up your tax deduction window.
Thank you very much for that one, Garrett. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. In the studio today is Brice, Payne, and Garrett Ray. And we're talking about the big beautiful bill and what that means for your retirement plan. Let's move on, Garrett, to the next one, senior citizen deductions. This really is in our neck of the woods now as financial planning specialists, retirement income certified professionals as we are. The senior citizen deductions.
Yeah.
Talk to us about these. This is some good news if you're a little bit on the older side.
Yeah. So I'd say this is universally, most people would say this is a good thing. Often it is our senior citizens that do find themselves on fixed income or means of limited income. And so sometimes many families are looking to, pinch as many pennies as possible. What this allows is there's now an additional deduction of $6,000 per person. So that's $12,000 if you're married and filing jointly, for people the age of 65 or older. You have to stay under certain income thresholds. I mean, you can't be like a massive income earner in your elder years and still qualify for this. But for the vast majority of our senior citizens out there, they are going to get an additional deduction that our younger workforce just doesn't get. And this is basically understanding the fact that many people, when they're 65 or older, they're no longer working or they're starting to phase out of work. And it's basically helping them kind of extend their dollars per year. So,
all right, very good. Let's go ahead and move on to the next one, Roth opportunities. So what do we mean by this?
Yeah, so essentially there was some concern with the political talking heads that the big beautiful bill may impact the Roth IRA, and specifically the IRA to Roth conversion. So meaning, can you convert a traditional IRA to a Roth account? Previous to the big beautiful bill, there was no limitation on how much you could convert if you were willing to pay the taxes on it. So hypothetically, if you had $1 million traditional IRA and you had means to pay the taxes, you can convert all of that $1 million to a Roth designation, and then you pay the taxes one time, and then that grows, assuming the account's open for 5 years or more. All the growth on that that hypothetical $1 million is now tax-free.
Now, Garrett, I'm sure, sorry to stop you, that somebody out there in the Triad area who's listening to us said, well, wait a second, Garrett, you just said $1 million. I know that I can't contribute more. I can't put more than, $8,000 or whatever into my Roth account. There's a difference between a contribution and a conversion.
Yes.
What we're talking about here are conversions.
Correct. Yeah. The contribution is the limit on how much you can contribute to your IRA or your Roth each tax year. A conversion is converting between the two designations. And so there previously was no limit on those conversions. And the big beautiful bill essentially upheld that. So there are still no limits on it. So again, you have to have the means to pay the taxes on the conversion, but you can still do it.
But I personally think the government likes the fact that somebody could convert and they can get their Uncle Sam can get his tax dollars now.
Oh, sure.
I don't see them. I don't know for sure what goes on in all of their heads, but I don't see why they would limit the conversions. They would rather get their money sooner than later.
Yeah. I mean, let's just for a moment think about someone, you've got person A and person B. Person A does what I think a lot of people do. They have a traditional IRA or a 401k, and they're just going to, over the years, take a distribution from that during their retirement to supplement their income from Social Security. And effectively, if you're Uncle Sam, you're getting a little bit of tax revenue each and every year based on the frequency of that person's distributions. If you have person B who's thinking about, taxes might be cheaper today than they could be in the future, I'm going to do an aggressive conversion strategy today. Yeah, I'm going to have to sign a big tax bill over to Uncle Sam, but I do basically rip the Band-Aid off. I do it one time. To Uncle Sam's eyes, he's looking at that account saying, oh boy, I get all this tax revenue all at once, or maybe over the course of like 2 or 3 years versus having to wait 15, 20, and 25 years of someone's full retirement. Yeah, Uncle Sam's going to take that deal.
Absolutely, he will. That leads us to a great segue here. Again, I said this in the first segment. Let me say it again in this one. We are holistic financial planners. We are retirement income certified professionals. What we want to do is not just have your portfolio properly allocated, but we want to employ strategies that are going to allow you to keep as much of your money in your hands, out of Uncle Sam's hands as possible. I'm going to ask everybody out there who's listening, raise your hand if you think taxes are going to go up in the future. If you raised your hand, then you would probably want to at least consider how much of your IRA should you convert to Roths and during what years, over what time periods, and how much. In almost all cases, you do not want to convert 100% of your IRA money to Roth. You want to leave a certain amount in your IRAs, but we use proper software programs that help us understand what that number is. If you've got $1 million in your IRA, how much of that should you convert to Roth money? Probably not going to be all the $1 million, but we've got the software to help us figure that out. If you would like to sit down with us and that be one of the points of conversation, give us a call, 336-391-3409, or our website, thewealthguardians.com. There is no cost or obligation to sit down with us. Who out there doesn't want to employ a tax mitigation plan so they're keeping as much of their money for themselves and out of Uncle Sam's hands as possible? I think just about everybody listening would like to do that. All right, Garrett, let's go to the next one. You want to talk about the bonus depreciation?
Yeah, so this one, this is a smaller line item, but it is, if you're a small business owner or you happen to have a rental property portfolio, this does apply to you. So there is an added 100% bonus depreciation that applies to qualified businesses, meaning you purchased a structure for your business, or you have rental property purchases made on or after January 19th, 2025. So if you're listening to this episode, then any purchase that you've made now, this certainly applies. But basically what it's trying to do is to allow you to depreciate that property faster, which is going to save you on some taxes.
Okay.
So, yeah.
Very good. Few odds and ends that are also on this bill. Charitable giving.
Yeah, so this is kind of the catch-all, charitable giving. So you do get now an above-the-line deduction for non-itemizer. So if you're one of those people who generally takes the standard deduction when you file your taxes, you basically get an additional $1,000 for charitable giving if you're single, or up to $2,000 if you're married filing jointly. So if you are charitably inclined, but you don't want to go through the pain of itemizing, you have up to $1,000 if you're single, $2,000 if you're married.
Yeah, it used to be that if you're taking the standard deduction, you didn't get to add your charitable giving in.
Correct.
Now you do. Great. Okay. Auto loan interest deduction, so that's changed a little bit. The EV credit is going away.
Let's talk about the auto loan,
Okay.
though,
All right, let's talk about it.
Because this is,
Oh, yeah.
to be clear, it has to be a car that has final assembly in the United States. So,
And I thought to myself, what are we supposed to put down there? What kind of car we bought on our tax return? Is that?
yeah, so just make sure that if you're buying a foreign brand, know where that thing was finalized. Like I know, for example, if you're a BMW person and you're buying an X5, hey, that final assembly plant's in South Carolina, so that actually counts.
There you go.
So, but other BMW makes and models may not.
May not.
So,
there you go.
So,
all right.
Yeah.
Well, thanks for that, Garrett. Unfortunately, that is all the time that we have this week. I want to thank you for joining us. We hope the rest of your weekend is everything that you want it to be. This is Brice Payne, along with Garrett Ray, the show's The Wealth Guardians, helping you retire the job and keep the paycheck. And I want to remind you, sound financial plans They don't create themselves. This is News Talk 94.5 WPTI. This is 96.7 FM WTOB.
Hi, it's Garrett Ray with the Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.